Hi, I'm Jimmy. In this video, we're going to look quickly at a few key stock market indicators to see if we can determine how overvalued the stock market is today from a historical perspective. We're going to use three famous economic indicators, not really economic indicators, stock market indicators. We're going to use the Buffett Indicator, the typical standard PE ratio, and the Shiller PE ratio. Okay, let's dive into this thing. So how about we start with the Buffett Indicator? First off, what is the Buffett Indicator? Well, to calculate it, all we have to do is we take the total market cap of the stock market, and then we divide that by the US GDP. That's what this chart represents. So right now, the market cap of the stock market, for the stock market, I used a Wilshire 5000 total market index. Well, right now, the market cap is 183% of the size of GDP. So clearly, this is a crazy high number. Now, I was able to find data going back to about 1970. So over that time period, well, this indicator has never been as high as it is right now, which tells us that the stock market isn't just overvalued, it's way overvalued. Now, to be fair, there are those that believe that the Buffett Indicator is a good representation of the value of the stock market, and some believe it's not quite as good. Well, back in December of 2001, Warren Buffett did an interview with Fortune magazine. And in that interview, he was quoted as saying something along the lines of, this was probably the single best measure of where valuations stand at any given moment. So clearly, this is high praise from a high place in the world of investing. And then when we switch back to the chart, well, we can see that the most recent numbers, well, this is partially due to the stock market rising in the face of falling GDP, which I think we can safely assume is historically unusual. So that at least partially explains the sort of huge jump in most recent times. Now, we can see that even before that, well, the Buffett Indicator was up near highs over the past 50 years, so it was already high. And then the stock market's done what it's done this year. So clearly, this is telling us that the stock market, relative to the overall economy, is overpriced at this point, probably way overpriced. Okay, now we'll come back to this one in a minute and look at how we might be able to take advantage of this. But for now, let's switch over to the more classic price to earnings ratio. So I was able to find the price to earnings ratio for the S&P 500 going back to 1954. And just so we're all on the same page, so to calculate the price to earnings ratio, we simply take the current price of a stock or an index or whatever we're using, and we divide that by the earnings per share. Earnings per share is the same thing as profit per share. So it's price divided by profit. The theory being that we, as investors, want to pay as low of a price as possible for every unit of profit that we're getting. So the lower, the better as far as the PE ratio is concerned. Right now, we're sitting at about 27 times earnings. So clearly, this is on the high end of the past 70 or so years. And only a few times has it gotten up near this level. We saw it in the early 90s, and at that time, I think the high was right about 26 times. So right around where the current level is. And if we're curious, the peak of the S&P 500 was, for PE ratios, was in December of 1992. And if we look at, let's say, 2 years from that point, well, that would be this time period. So we can see that at the peak, the PE ratio was about 26 times profit. By the end, it was about 17 times profit. So this is a pretty big decline from a PE ratio perspective. But, and this is a really huge but, look at what the S&P 500 did during that same time period. Now, I was actually surprised to see how the stock market was, let's call it flat to slightly up. And we have to remember that back in December, well, the S&P 500 was trading about 441. They had a PE ratio of about 26x. 2 years later, it was only up about 4 points to 445. And at that point, they had a PE ratio of 17 times earnings. Now, the reason that I bring this out is I think it's important for us to remember that this is always a possibility. It's always possible that the stock market ends up moving sideways and earnings gradually catch up, lowering the overall price to earnings ratio. In fact, during the 1990s, well, the stock market actually did quite well. This is what the entire 90s looked like. This goes from December 31st of 1989, so the day before the 90s began, all the way through to December 31st of 1999. So we can see that the stock market did quite good during that entire time period. Now from 1994 forward, it really took off thanks to what would eventually become the tech bubble. Now that leads us to the next possibility of what could happen with the stock market. Now on this PE ratio chart, well, in the early 2000s, once again, the price to earnings ratio hit the biggest high that we have during this time period. It's the only one that's higher than the current level today. And from the peak of that, well, the stock market was actually down almost 40% over the next few years. So I think in the 3 years after the peak of the PE ratio, it was down about 36%, I believe it was. Okay, so clearly there's a few possibilities as far as what could happen when the stock market PE gets too high. Now let's shift over to the Shiller PE ratio. We might also hear this called the CAPE ratio. CAPE is short for cyclically adjusted price to earnings ratio. And basically what this ratio does is it takes the current price and it divides it by the average earnings from over the past 10 years, and those earnings need to be adjusted for inflation. And we can see here that this data goes all the way back to the year 1900. And this data was actually easier to find than some of the other data because Robert Shiller, the creator of the Shiller PE ratio, he actually publishes this data on his website. So either way, right now, the Shiller PE ratio is at about 31 times the average real earnings. Real is when it's adjusted for inflation. Okay, so clearly we're at a very high level. In fact, over 2 times over the past 120 years has this stock market indicator been this high. The first one was the Great Depression, and the second one was the tech bubble. So clearly this is very dangerous territory we're in right now. We're near all-time highs with the Shiller PE ratio, and we switch back to the traditional PE ratio. Once again, we're sitting at a super high level. We're near highs going back to the 1950s, and then when we jump back to the Buffett indicator, well, now we're actually sitting right up near all-time highs over the past 50 years. So, what does this mean? Does this mean that we should not be investing at this point? Should we just wait for the stock market to crash before we jump in and get involved? And I'm actually in line with Warren Buffett's way of thinking when it comes to trying to determine when to invest. It seems that the key to investing in a time like this is that we do our research and we look for our best investment opportunity. Just to illustrate, sticking with the Buffett indicator here. Well, back in 1998, Warren Buffett bought General Reinsurance for about $22 billion. And at that time, the Buffett indicator was at its highest level, at least according to how far back our data history goes. It would have been the highest level even if Buffett had gone back further with his analysis. Point is, buying General Reinsurance still made sense, despite the fact that we know that the Buffett indicator was correct, because we know that after the tech bubble happened, the stock market headed lower. Yet, that did not stop Warren Buffett from buying General Reinsurance, and General Reinsurance has been an excellent asset for Buffett and for Berkshire Hathaway for a long time. The same is true back in 2014 when Berkshire Hathaway bought Duracell. So once again, the Buffett indicator was relatively high compared to its history, but still, they jumped in and bought Duracell when the opportunity presented itself. And then he bought Precision Cast Parts in 2016 as the Buffett indicator hung around about the same level. It was a little bit higher, but broadly speaking, about the same level. And then he jumped in and bought Dominion Energy in 2020 while the Buffett indicator is crazy high. Now, the point being that just because the Buffett indicator is saying that, broadly speaking, the whole stock market is overvalued, that does not mean that there are not individual opportunities that we can identify. It's very possible that we find a great investment that we buy right now and we hold it for many years and it serves us very well. Granted, Buffett made way more deals during the financial crisis back at this time period, and there were way too many companies for me to even list here that went on sale, and he made a killing on those. Now, I'm not suggesting that it doesn't matter what these charts are saying, as it doesn't matter as to what we do. I think it matters very much. Clearly, profits, if we buy at the bottom, are going to be way bigger than if we buy near a top. But what I'm suggesting is that it's very difficult to time the market. And since it's so difficult to time the market, aren't we better off just looking to identify individual opportunities? Now, let's pretend we can't really find any opportunities, and next year the stock market crashes. if the stock market crashes, it would be good to have a company, a handful of good, solid companies that we know we like. So when their stock pulls way back, we can jump in and buy it at we can buy the right opportunities at the right price. If we haven't found any great companies and the stock market crashes, well, I think it'd be a more logical time to jump in and buy an ETF perhaps that covers the broader stock market. But until that happens, I think it makes more sense to stick with researching individual companies to see when we can find that next great investment. Now, if you're curious, I actually did a video where I go through 8 simple steps to analyzing a company. So if you're interested, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.